So what's whole life insurance? Well, whole life insurance acts a lot like universal life. You've got a premium. The premium is going to accrue a cash value. There's mortality and expense costs that come out. There's administrative costs, and there's statutory reserves set aside. It looks a lot like that universal life insurance policy. The difference is everything's locked in. So the insurance company, when they issue the policy, they have locked in all the moving parts. You know, when you buy a whole life policy day one, what it's going to look like in year 20. You can look at the schedule and you can see I make these 20 years of payments. This is what the cash value is guaranteed to be. So because the insurance company now is guaranteeing the cash value element, they are guaranteeing the death benefit element, they're going to write this whole life policy a little more conservative over time. So initially, you're going to have quite a bit go in the statutory reserves for whole life. Because if you get a whole life policy when you're 20, there's not much cash value and there's a lot of death benefits. So we have to cover that death benefit, make sure there's enough in there to pay if you pass away. Insurance charges, though, are going to be pretty small, right? When you're 20, it doesn't cost that much. Then you've got your expense load up front. And your expense load up front is going to do everything from pay the underwriting costs, administrative costs, if there's a commission that goes to an agent or broker, all that comes out in year one. And then what's left kind of goes in the cash value over time. But a whole life policy endows at age 100, generally speaking. So you may be like, what do you mean? Well, endows mean that the cash value is scheduled to hit the death benefit at age 100. And so if you live to 100 and you have a traditional whole life policy, it will write you a check at age 100 and you get that amount, which happens to be where the cash value caught the death benefit. So that's the idea of a whole life policy. It is all guaranteed. Growth rate's guaranteed. The one moving part of a whole life policy is if the policy is participating or non-participating. A participating whole life policy is one where if the company has excess profits on, for example, the reserve account, they can pay a dividend to policyholders. You can't count on the dividend, but in the event that, let's say that the insurance company has a 15% market year, all right? Say they earn 15%. They have billions of dollars set aside, and they earn 15% on those billions of dollars. Well, that surplus, they're probably going to pay it out in dividends. So policyholders in a participating policy, when your insurance company has good results, you get an extra check. That's called a dividend. We don't count on dividends in whole life. We never count on them, but it can be an additional reason that whole life insurance is more attractive than universal life, which isn't going to come with participating status. So whole life, guaranteed, locked in, you know everything ahead of time. With that cash value, if you leave it alone, you know what's going to happen. If you start borrowing against it, that's a different story, right? If you start borrowing against whole life, now you've accrued some debt, so it may not perform like you thought it would. But there's different types of whole life. You've got traditional whole life. You just pay the same amount every year the rest of your life. You've got limited pay, where let's say you inherit a ton of money and you can do a limited pay. So we're going to take all those premiums and find out what they would be over 5 years. So you're going to pay huge premiums for like 5 years and then you're done paying. So those are different ways whole life works. But the difference here is it is all contracted, agreed ahead of time. Yes, it's more expensive, but there is little risk to the insured as long as the insurance company stays in business and everything is great. This whole life policies work out. But again, whole life is not a short-term deal. We don't want to buy a whole life policy and 5 years later surrender it, right? That will not get us where we want to go. It will appear as though we've lost a lot of premium dollars. Now, on the other hand, 60 years later, some of these whole life policies that pay dividends can be very attractive and a big piece of somebody's estate plan. So that's where we see whole life, all locked in, all guaranteed, all promises. But again, it's a long-term deal, and this is not for a short-term insurance need. So we're not going to use whole life to cover death benefit until our kid goes to college. We're going to use whole life for something like an estate plan. We're going to use whole life for something, maybe we're gifting policies down generations. We can use it for that kind of stuff. Maybe in an ILET in your irrevocable life insurance trust, we can use whole life there. But we're looking at permanent long-term needs, and whole life, participating especially, can be very attractive in those settings.